Okay, let's dig into this. We're looking at a source today that really paints a picture of, well, significant stress building in commercial real estate. This is as of the first quarter of 2025.
That's right. And our source is an article from Michael Linton. He's with the Chicago Deal Flow team. You can actually find it on chicagodealflow.com.
And Linton's background is pretty extensive, right? Commercial broker, investor, based in Chicago.
Yeah, over 38 years, the article says. Hands-on experience in finance transactions, so a really knowledgeable perspective.
Definitely. So our goal here is to unpack the key insights from this analysis, really get a handle on what's actually happening on the ground and, why it matters for you. Let's jump in.
Yeah, and what hits you right away is that this isn't just like speculation. The source uses Q1 2025 data to show this stress is broad. It's not just one or two isolated things.
Right, that's the core problem highlighted immediately, this surge in delinquencies in Q1. The main finding is pretty stark. Delinquency rates went up across all major capital sources and all property types.
Exactly. So it's not confined. It's systemic stress we're seeing. If you break it down by where the money's coming from, CMBS, Commercial Mortgage-Backed Securities, they really led the way.
Led the way down, you mean?
Right. Led the decline. A dramatic 64 basis point jump in Q1. That took the CMBS delinquency rate to 6.42%.
Okay, wait, 64 basis points. That's over half a percentage point increase in just 3 months.
In 3 months, yeah. And the article points out CMBS is often more vulnerable, maybe because of the types of loans or properties they hold. And that 6.42%, it's over 5 times higher than the rate for loans held by banks.
Wow, that ratio really tells a story, doesn't it? Shows where the most intense pain is right now.
It does. Now, banks and thrifts, the more traditional lenders, they also saw an increase, but much smaller.
How small?
Just 2 basis points, bringing their rate for loans 90-plus days late, or what they call non-accrual, up to 1.28%.
Okay, 1.28%. So 2 basis points sounds tiny compared to 64, but for banks who are usually pretty conservative, any rise is probably, well, a concern.
It is. They watch those trends very closely. And then you look at the GSEs, Fannie Mae and Freddie Mac, big players in multifamily.
What's happening there?
They both saw identical increases, 6 basis points in Q1. So Freddie's rate went to 0.46%, Fannie's to 0.63%. That's for loans 60-plus days past due.
Okay. So even in multifamily, which has been, pretty stable historically, seeing increases there from Fannie and Freddie, even small ones, that suggests the stress is spreading.
Absolutely. It suggests the pressures reaching sectors and lenders that maybe felt more insulated before, even life insurance companies.
The most conservative lenders, usually.
Exactly. They saw a 4 basis point increase to 0.47%. Still the lowest rate overall, by far. But the fact that it's ticking up even for them shows this distress is pretty widespread.
So rising delinquencies everywhere. That's the first big takeaway. But the article brings up another huge factor, this maturity wall.
Yeah, this is where the scale just becomes, well, kind of daunting. The source estimates around $957 billion in commercial mortgages are coming due, maturing, just in 2025.
Wait, say that again? $957 billion.
Billion. With a B. Almost $1 trillion.
Just this year. Wow, okay. Let that sink in.
Yeah. And if you look out just a bit further, through 2026, the total hits $1.5 trillion.
Good grief. That's a staggering amount of debt that needs to be refinanced or dealt with somehow in a market that's, well, very different now.
Precisely. Think about when these loans were written versus today's environment. Which sectors are facing the biggest wave?
I'm guessing multifamily and office, given the numbers.
You got it. Multifamily has the biggest chunk, $257 billion maturing this year, 2025, and another $289 billion next year. Office isn't far behind, $206 billion this year, $234 billion in 2026.
So you've got these rising delinquencies and this massive wall of debt coming due. It sounds like a perfect storm brewing.
It really does, and the source includes a quote from Michael Linton that sums it up perfectly. He says, let me find it here, "The combination of elevated interest rates and the massive maturity wall creates an unprecedented challenge for property owners."
Unprecedented challenge. Okay.
He goes on, "Many borrowers who secured financing at historically low rates are now facing debt service increases of 75% to 100%, fundamentally altering the economics of their investments."
75 to 100% increase in debt payments? That just fundamentally breaks the model for a lot of properties, doesn't it?
It absolutely does. It's not just that the loans are maturing, it's what they're maturing into. This totally different interest rate world.
Yeah, the rate reality. Let's talk numbers there. What are current commercial mortgage rates looking like? according to the source. This is as of June 2025.
Right, so the article gives us some figures. Multifamily rates, they're starting around 5.43%. Office and industrial, you're looking at rates starting higher, around 6.83%.
Okay, 5.4% to almost 7%. And compare that to, say, the post-pandemic period or even before when a lot of this debt was originating.
Oh, it's a world of difference. Many of those maturing loans were locked in when rates were well below 4%, sometimes even in the low threes.
Yeah.
The source even points out bridge loan rates for riskier or transitional deals are hitting as high as 9% now. That just shows you how much risk lenders are pricing in.
So if you're an owner, maybe you had a loan at 3.5%, 3.8%. Now you go to refi and you're staring down 6%, maybe 7%. That's the 75-100% payment shock Linton talked about.
Exactly. That's the immediate cash flow crisis for the property owner.
Yeah.
Unless the property's income has somehow magically doubled, which is unlikely.
Right.
The old math just doesn't work. Refinancing becomes incredibly difficult, maybe impossible, without bringing a lot of new cash to the table.
And the Fed's role here, keeping rates higher for longer.
Absolutely key. The source mentions the federal funds rate holding steady at 4.25% to 4.5% through the third Fed meeting of 2025. That benchmark rate ripples through, keeping all borrowing costs elevated.
So macroeconomic policy hitting Main Street CRE, essentially.
Okay, so the stress is broad, but it's not hitting all property types equally, right? Where's the worst pain?
The source is pretty clear. Office properties are really bearing the brunt, especially in the CMBS world. What's the number there?
CMBS office delinquency hit 10.59% in May 2025.
Over 10%. Wow. Just for office loans, package and securities, that signals deep trouble.
It really does. Now, interestingly, that's actually slightly down from an all-time high of 11.01% back in December 2024.
It's
Still
incredibly high.
Oh, yeah. It's more than 3.5 percentage points higher than just a year earlier. It just reflects those ongoing structural shifts, like remote work hitting the office sector hard.
Okay, so office is the obvious one. What about multifamily? You mentioned delinquencies creeping up there too, especially CMBS.
Yeah, multifamily is showing some really concerning signs, again, particularly in CMBS. That delinquency rate surged 113 basis points.
113.
Yeah, 1.13 percentage points. In April 2025 alone, that pushed the multifamily CMBS rate to 6.57%.
Whoa, a jump like that in a single month. That sounds alarming for a sector usually seen as stable.
It is. The article notes that 6.57% is nearly a five-fold increase from the 1.3% rate they saw just 1 year prior in April 2024. So yeah, rapid deterioration. It suggests the pressures are escalating quickly there.
So office has these long-term structural issues. Multifamily CMBS is seeing this sudden, sharp spike. What about other sectors briefly?
The source mentions lodging or hotels continue to be volatile. Retail still facing those headwinds from e-commerce. That's a longer-term story.
But industrial?
Industrial is generally holding up well, still resilient. Strong demand for logistics, warehouse space. You know, the flip side of that e-commerce coin.
Right, makes sense. One benefits where the other struggles. Now, geography matters too, the article says. It's not the same everywhere.
Definitely not. Regional variations are significant. Generally, coastal markets seem to be showing higher levels of distress, think higher vacancies, maybe more value declines compared to, say, secondary markets.
And Chicago. Since the source is from Chicago deal flow, it gives us a local look.
Yeah.
How's Chicago doing in this environment?
Yeah, the article gives some specific Chicago data points, which are interesting. Office vacancy nationally, the source puts at 22.6%. Chicago's is lower, at 19.2%.
Okay, so still high, nearly 1/5 empty, but relatively better than the national average cited. Suggests maybe a bit more stability, perhaps.
Potentially, yeah. Or at least not hit quite as hard as some other big cities. Multifamily in Chicago has shown resilience too. Absorption was positive, around 12,500 units recently.
Cool.
But the source notes that's actually down from peak levels seen earlier. So still demand, but maybe slowing down a bit.
And industrial. We said it was strong nationally. Same for Chicago.
Very much so. Chicago's industrial market is a real bright spot, according to the article. Vacancy is stable, low 5.5%. Demands is robust, 8.5 million square feet absorbed in the past year.
Wow.
Yeah, it highlights Chicago is actually one of the top 10 U.S. markets for industrial demand. Its location infrastructure, that really helps.
So Chicago's got this kind of mixed bag, but with real strength in industrial. Linton has another quote about Chicago specifically, right?
He does. It kind of sums it up. Chicago's diversified economy and strategic location provide some insulation from the broader commercial real estate challenges.
Some insulation, okay.
But then he adds the crucial caveat. However, even in relatively stable markets like Chicago, investors and property owners must remain vigilant about refinancing challenges and changing market dynamics.
Vigilant. That seems like the key word right now, regardless of location. Even in stronger markets, that maturity wall and high rates are a factor.
Absolutely critical. So how's the market adapting? The source talks about institutional
Right,
investors.
the big players with capital. It sounds like they see opportunity in this distress.
Oh, absolutely. They're actively targeting opportunistic investments. The article gives a specific example. Brookfield Asset Management. In just Q1 of 2025, they raised almost $6 billion
$5.9 billion.
for a new opportunistic fund. That brought their total dedicated to these kinds of deals up to $16 billion.
$16 billion ready to deploy into distressed situations. What are they looking to buy?
They're focusing on distressed properties or situations where owners need to cash out. Specifically mentioned are apartments and warehouses, so multifamily and industrial.
Ah, interesting. Targeting multifamily where stress is emerging, and industrial, which is fundamentally strong but might have owners hitting that refi wall.
Exactly. And they're looking to buy these assets at significant discounts. The article mentions 20% to 40% below peak values.
That's a pretty steep discount. Buying solid assets from owners who are forced to sell because of debt issues.
That's the strategy. And it's not just Brookfield, it's a broader trend. Private equity real estate funds overall raised over $57 billion in Q1 2025, specifically for distressed opportunities.
$57 billion. And how does that compare to before?
It's a big jump, compares to about $32.5 billion raised for the same purpose in Q1 of 2024. So you see this real acceleration of capital positioning itself to capitalize on the dislocation.
So a tale of two markets almost. Struggling owners on one side, well-capitalized investors seeing opportunity on the other. What about the lenders, the banks? Especially regional banks. How are they weathering this?
Yeah, the regional banks are under particular pressure. The source highlights their often higher concentration of CRE loans compared to the money center banks.
Right, it's a bigger part of their balance sheet.
Yeah.
And are they already seeing signs of strain?
Yes. The article notes an increase in loan modifications. Banks with under $100 billion in assets modified 0.32% of their CRE loans in the first 9 months of 2024.
Okay, 0.32%. Sounds small, but is it rising?
It is. That was up from just 0.1% in the first half of 2024. So it shows an increasing trend of banks trying to work things out, modify terms rather than just foreclosing.
Trying to avoid taking a loss immediately.
Right. And this concentration risk, combined with that huge maturity wall, it definitely creates potential systemic risk that regulators are watching very closely.
Yeah, you hear concerns about that. The source mentions extend and pretend.
It does. That's the term often used when lenders extend loan terms or adjust covenants, basically hoping market conditions improve down the line, allowing the borrower to eventually refinance or sell without the bank recognizing a loss now. It's kicking the can down the road, essentially.
Wise time, but doesn't fix the underlying economics if the rates stay high and values are lower.
Exactly. So, okay, we've covered a lot. Rising delinquencies, the massive maturity wall, high rates, office and multifamily stress, regional differences, investor opportunism, bank pressure. Let's boil it down. What does this mean for you, the listener?
Yeah, depending on your perspective, what's the takeaway? Let's start with property owners.
For owners, especially those with debt maturing soon, the message is pretty stark. Immediate refinancing pressure. You might need to inject significant new equity.
Meaning come up with more cash yourself.
Yeah. Or accept much lower leverage, meaning a smaller loan amount relative to the property's value. Or, in tougher cases, you might be facing a distressed sale if the numbers just don't work at today's rates.
A difficult reality check for many. What about for lenders?
Lenders are tightening up much stricter underwriting standards for new loans. And they're spending a lot more time and resources on loan workouts, trying to find solutions for troubled borrowers to minimize their own losses.
Makes sense. And then for investors, the ones with cash.
For them, as we discussed, this environment presents, and the source uses the term unprecedented opportunities.
Unprecedented.
Yeah. Motivated sellers needing to deal with maturing debt combined with tighter lending. It creates a window for savvy investors to buy assets, potentially really good assets, at significant discounts.
But it takes a certain skill set, right? Linton had that quote.
He did, about needing deep market knowledge, strong financial backing, and the ability to move quickly on opportunities.
Right. So not for the faint of heart or the unprepared. It rewards expertise and capital.
Definitely. So finally, the article looks ahead. What's the future outlook?
What factors shape where we go from here?
Well, a few key things. Federal Reserve policy is huge. Do rates stay high or start coming down? The overall pace of economic growth matters. And just fundamentally, how effectively borrowers and lenders navigate that giant maturity wall.
And the prediction for delinquencies, still rising.
Projections mentioned in the source suggest yes, delinquency rates likely continue to climb, especially again in CMBS and for office properties. Seems the trends we saw accelerating in Q1 are expected to continue for a while.
Which likely means more distressed sales.
That's the expectation. More properties hitting the market under duress as refinancing options run out. And that could create a negative feedback loop.
Where distressed sales pull down comps and valuations for other
And
properties.
it's exactly making refinancing even harder for the next guy. It's a potential downward spiral effect.
And the regulators, they could influence things too.
Oh, absolutely. Bank regulators are watching CRE exposure very carefully, especially at those regional banks. If they tighten requirements further, maybe demand higher capital reserves against these loans. That could constrain lending even more.
Forcing banks to deal with problem loans more aggressively, perhaps.
Potentially, yes. Accelerating the market adjustment.
Okay, so wrapping this up, this deep dive, based on the analysis from Michael Linton and Chicago Deal Flow, really shows that Q1 2025 wasn't just a blip. It signals something more fundamental, a repricing of risk in commercial real estate because of these higher rates.
That's the core of it. And it's creating serious hurdles, especially for existing owners and lenders staring down that maturity wall. Big challenges there.
But on the flip side, it's also creating clear opportunities for investors who have the capital and the know-how to navigate these distressed situations. It seems like adaptation is key for everyone involved.
It is. Some will adapt successfully, others might face significant pain.
Which leaves us with a final thought for you, the listener, to chew on. We're seeing this dramatic shift in how risk is being viewed and priced in commercial real estate. What might that imply about value, about risk, about opportunity in other markets or other types of investments you might be looking at? How does this repricing ripple outwards?